Hello all, welcome to www.bispsolutions.com. In the webinar series of financial planning using Excel, today we'll see discounted cash flow. Discounted cash flow, or DCF, is a valuation method used to estimate the present value of an investment based on its expected future cash flows. It helps in determining whether an investment is worthwhile by discounting future cash flows to the present using a discount rate. It is based on the concept that a dollar received at a future date has a lower value compared to a dollar received today because of the time value of money. So entire DCF model we going to base on this important assumptions. The time factor of money is very important in this model. DCF analysis can be applied to a value to value a stock, company, project and many other assets or activities, and thus it is widely used in both the investment industry and corporate finance management. Here in the formula you will see the components of DCF. First we have cash flow. So you can see the CT over here, this is cash flow. So these are the expected cash inflows and outflows that will be generated by the investment in the future. This may include revenue, operating expenses, taxes and capital expenditure. Then it is divided by 1 plus R raised to power T. So over here R is the discount rate, which reflects the risk associated with the investment. It can vary based on the company's risk profile, market conditions and the specific project's risk. A higher discount rate indicates higher risk and consequently a lower present value. And then 1 plus R, it is raised to power T. That means this is time period T over here. So each cash flow is discounted to its present value, considering the time period at which it is expected to occur. Now typically cash flows are projected into the future for several years. Let me explain you, this must be looking a bit complicated, but here we are going to use certain mathematical formulas to derive a discounted cash flow. But let me explain you in simple layman's language with the help of this user story. So Jack owns a small bakery, okay, and he is thinking about opening a second shop whose setup cost is over here. You can see that the setup cost, it is $60,000 today. Now here in the table below you will find he has already estimated the profits for future profits, okay. For the first year it would be $20,000, second year $25,000 and finally third year would be $30,000. This is his estimated future profits, which is distributed over the next 3 years. Now but money, this is what is the basic point over here, that the money in the future is worth less than today. So we will discount those future profits using a rate, let's suppose 10%. Okay, so we get the discount factor, and with the help of this we'll find the present value of these future estimated profits. When we add it up, all the 3 years present value, we get it as 61,382. So total discounted cash flow value over here is $61,382. Now I've already told you in the beginning that he is planning to open a second shop. and the setup cost, he's assuming it will be $60,000. But since DCF value is greater than $60,000, it means this expansion is a good idea, because future profits, if we discount it to the present value, it is greater than the setup cost. So since the profit is greater than the cost, he can go forward with his decision of opening this new bakery. So in more simpler terms, imagine you have two options. Someone gives you $100 today, and someone promises to give you $100 after 5 years. Which one would you prefer? Ideally, most people would choose here $100 today, because you can firstly invest it and earn interest. Also, the inflation reduces the value of money over time. There's uncertainty in the future. So, discounting the future profits as per the assumptions of rates and various other assumptions which we're going to take, and seeing the value of that with respect to the present value. This is all about discounted cash flow. So it is very helpful, especially in investment analysis, because with the help of DCF, uh, the investors can quantify the intrinsic value. It will provide you whether you can invest in the future. It will provide you the amount, whether your investment decision is correct or not. So this will facilitate the risk adjustment returns. It will assist in asset allocation. Of course, you can compare the investment opportunities. So to find out whether your future investment is safe or not, we will adopt discounted cash flow method. To perform discounted cash flow, these are the following steps. First one, you have to forecast free cash flow. Step 2, you have to calculate weighted average cost of capital, also known as WACC. Then we're going to calculate terminal value. We'll discount the free cash flow and terminal value that we have calculated earlier in the step 1 and step 3. We're going to discount it, and on the basis of that discount rate, finally we're going to calculate the implied share price. So let's start this exercise. We're going to perform all these steps in the Excel. So first we're going to calculate free cash flows. That is the cash a company generates after covering operating expenses and capital expenditures. The formula over here you can see, it is EBIT multiplied by 1 minus tax rate plus the depreciation minus capex minus change in the working capital, that is increase or decrease in the working capital. For this calculation, I have made certain assumptions. So here I have got EBIT, which is 150, tax rate is 25%, depreciation is 15, amortization is 20. See, if you are having depreciation amortization as percentage, then you have to have the tangible and intangible asset value also. So due to time constraint, I am straight away taking the depreciation amount. Capex is 50, and changes in working capital, that is there is decrease of 12. EBIT will be as it is, there is no calculation in it. tax over here, you've got EBIT multiplied with your tax rate, and since tax is a expense, this would be in minus, this would be negative. Depreciation and amortization, we're going to add up both of these figures. Capex will pick up straight away from here, but this will be negative. In the formula, if you see, capex is being deducted, so we are, since here I'm summing it up, so I'm beforehand only changing the sign over here. In case you want to keep it positive, you can keep it, but then you have to change the formula for calculation of FCF. And changes in working capital is, again, this is also in negative. If I sum this entire thing over here, so what I'm doing exactly here, EBIT, okay, this is already, I have multiplied it with the tax rate, so here I have got this figure. Okay, this is 38. Then I'm adding depreciation to it. Capex is being deducted, and change in the working capital, this is also being deducted. So the logic behind this is, firstly, depreciation, if you see, this is a non-cash expense. It will reduce accounting profits, but ideally it doesn't involve any actual cash outflow. For example, a company buys equipment for, let's say, 1 lakh. Okay, now that cash is spent today, it will depreciate over 10 years, let's say 10% depreciation, so 10,000 is deducted from earnings annually. However, no actual cash is spent every year. The full $1 lakh, that is the equipment price, was already paid in year 1. Now, since depreciation reduces net income, but it is not an actual cash expense, we will add it back to FCF. Talking about capex, these are real cash outflows which is needed to maintain or grow the business. If a company earns $1 million in net income, but it spends $3 lakh on new equipment, only $7 lakh will remain as usable cash. Now, since capex is an actual cash expense, we subtract it from FCF. Change in the working capital, this is deducted. Now, change in working capital, this is difference between your current assets and current liabilities. If your working capital increases, that means you have more cash is tied up. If the working capital decreases, so more cash is available. So that is why, since an increase in working capital ties up the cash, we subtract it from FCF. So I hope this is clear, the calculation of FCF. Let's move further. So here, after using this formula, we get to the figure at free cash flow, which is 86. So first step done. If I show you the slide, first, forecasting free cash flow. With the help of certain assumption, we have forecasted free cash flow. Second step, we have to calculate WACC over here. So let's see how this is done. second sheet. I'll go to the second sheet now. Now weighted average cost of capital that we're going to calculate. This represents the company's cost of capital, both your debt and equity. So it's the discount rate which is used to value future cash flows. The formula over here is provided here, which we're going to use to calculate weighted average capital cost of capital. Now E over here, this represents market value of equity. It is divided by total value of firm, that is E plus D. So V over here, this is actually E plus D. That means market value of your equity plus market value of debt. RE, this is cost of equity, and over here RD, this is your cost of debt, that is the interest rate on debt, and the tax rate is there. So for this we have got certain assumptions. I've got equity value, debt value, cost of equity is 10%, cost of debt I've got 5%, and tax rate is 30%. Now to calculate WACC, your first element is E by V. So let's calculate this first over here. So equity value, this divide by the sum of we'll take the sum. This is divided by V. So V is your sum of equity and debt. That means equity value and add debt value to it. So this is your E by V calculation, your first aspect in this formula. Second, let's calculate D by V, which is debt value divided by the total firm's value. Total firm value will be equity value plus debt value. So this, you have in calculation of WACC, you have here two elements, E by V and D by V. We have here separately calculated it. We can also do, we can calculate here in the WACC formula, we can do it straight away, but to make it simpler, I have calculated it separately. Now we're going to calculate WACC. So for this we require first your E by V value, that is this we have calculated. Now this is multiplied with RE, that means your cost of equity. Okay, so this is the cost of equity. So basically E by Y, this will be multiplied with cost of equity, close the brackets, plus then the second aspect is D by V multiplied with cost of debt. So this we have already calculated, D by V multiplied with your cost of debt, this multiplied with 1 minus tax rate. Okay, first here close the formula, now close the brackets and multiply it with the tax rate. This is the tax rate. So this way I'm getting it as weighted average cost of capital as 7%. So I hope this formula is clear to you. This is very simple. There are certain assumptions provided. You just have to calculate E by V and D by V and then multiply it with the cost of equity and cost of debt. Now next, let's see what is there. This is we have calculated free cash flow and we have calculated WACC. Now we have to calculate the terminal value. So uh, see, we don't, like in businesses, we don't stop after the forecast period. Like if we have forecasted for 5 years, the business doesn't stop at that time. It will go on, it will be carrying on afterwards also. So we estimate their value beyond that. Beyond that, if that forecasted period, let's say for 5 years, we will estimate their value beyond that using the terminal value. So let's see how this is done in another sheet over here. For terminal value calculation, here we are calculating terminal value for 5 years. Okay, so here this is the time period provided in years. EBITDA and FCF I have already told you how this is calculated. So after you prepare your income statement and you have the figure of EBITDA here, then you will work on FCF, and once you get your figures for FCF, you are going to calculate your terminal value. Here we will be using perpetuity growth method. Terminal value over here is FCF of the final year multiplied with 1 plus G and WACC minus G. So G is the growth rate. Okay, let's calculate terminal value here. FCF of the final year, this you can see is 72. This multiply it with 1 plus G, 1 plus growth rate, that is 1 shift plus the growth rate over here. This has been provided in the assumptions, and this is divided by WACC, which is also there in the assumption, minus the growth rate. So this comes out to be 984. This is the terminal value. Okay, even after 5 years this would be the value. It will keep on going, and this will be the value of your future investment. This is after 5 years terminal value. So we have done with the perpetuity growth method. There are other methods also, but to keep it simpler and due to time constant, we are doing just one method, which is the most ideal and popular over here. And even if you use other methods, it will more or less provide this figure. You can average it out, and more or less you will get figure around this value only. Whichever suits your business, you can pick up that method. After terminal value, we're going to discount free cash flows and the terminal value. So here we have calculated free cash flow. Third step, we have calculated terminal value. Now we're going to discount it at the present rate. This is what the motive of discounted cash flow. This is what we are trying to do. Since beginning, there are future profits being provided. We will estimate the terminal value, and those values we're going to discount at the present rate. Let's see how this is done. Another sheet over here. So I have got period of 5 years. Now here FCF we have already calculated, as well as terminal value we have already calculated. So I'm using I'm not providing these calculations again. Now we'll first calculate the discount factor, and that we're going to use for present value, or you can say discounted value of FCF and your terminal value. For the formula of present value, you can find over here FCF. When you're calculating present value of FCF is divided by 1 plus WAC raised to power the this is the T means time period. So for whichever year you want to do it, you can raise to power that. And similarly, if you are doing for present value of your terminal value, then terminal value would be divided by 1 plus WAC raised to power T. So here we have to take the assumption of WAC, that is 8%. Let's first calculate the discount factor of all. So 1 divided by 1 plus the period. 1 plus your WAC. Over here you can see 1 plus WAC raised to power T. Close the bracket. Raised to power, the time period over here is 1 year. And since I'm going to scroll this further to copy the same formula, I'll make it fixed by putting the dollar over here, and this you can do with your F4 key. You've got the discount factor. So this whole formula I've divided into two parts. First I've calculated the discount factor, and then I will multiply with FCF. So this is your discount factor. Okay, like future cash flow, it is, let's suppose 100 is the future cash flow for 5 years. If you discount it at the present rate, this is the present rate. Now we'll calculate present rate. This is the discount factor. Now we'll find the present rate of this future cash flow. So simply multiply this discount rate with the future cash flows. That means this is equal to future cash flow multiplied with the discount rate, respective discount rate for that period. And same goes for all the other periods also. So this is your like 100 in the first year. If it is going to provide, this is your future cash flows. You're assuming 5 years, 100 is the future you can say estimated profits. If you will discount it at the present rate, this profit presently will be at discounted rate. So you can see in the first year the discounted future price is greater than the 5th year. This is again estimating this on which the whole discounted cash flow is working, that the value of money, it reduces as the number of year increases. Now we'll calculate the present value of the terminal value. Over here, this is for the last year, the 5th year we're going to pick up over here. This is the terminal value over here, it's provided, multiplied it with your discount factor. Now finally the enterprise value is over here, will be the summation of the entire present value of FCF and present value of your terminal value, which is equal to, you can write here as sum, select the entire thing over here fine. So we're adding up the present value of future cash flows with the terminal value. So that comes out to be 943.74. This is your discounting cash flow. After this, once you have discounted free cash flows and the terminal value, the last step is to calculate implied share price. So this is, we are calculating the share price of that investment, which we are assuming like after 5 years the share would yield you, let's suppose, $50,000. So but this is after 5 years. What about the present year, present value? So therefore we are calculating the implied share price. For this we have already calculated enterprise value over here. This is the enterprise value, this you're getting. Okay, so the already calculated enterprise value, cash, marketable securities, short-term debt and long-term debt you will get from the balance sheet. And enterprise value, you have already done the calculations in the earlier steps. First we will calculate the equity value. With the help of that we will calculate share price. So the formula to calculate implied share price here, total firm value minus debt divided by the shares outstanding, total outstanding shares. So here we are assuming, let's suppose 150 shares are floating in the market. These are outstanding shares. First we'll calculate the equity value over here. So this is simply, equity value means all the firm's value over here minus the debt. This is equal to your enterprise value firstly. Then you will add up the, you will write here, you can sum of cash and marketable securities, and then deduct all the debts. So long-term debt, short-term debt, whatever debt you are having, deduct it. Then you will get the equity value. So this is 1250. Now outstanding shares, if we have assumed it to be 150, so it is easy to calculate the share price over here. This is the formula. Total, this is equity value, that is your total firm value. Firm value you have calculated by adding these three minus debt. So this is your equity value divided by outstanding shares. That means over here you're going to take 1 to 50 and divide it by outstanding shares, 8.33. So this is your discounted cash flow. You can see discounted price basically of your share in the present terms. So the implied share price from discounted cash flow calculation, this represents the intrinsic value, or you can say true value, of company's stock, which is based on its expected future cash flows. It tells us whether a stock is undervalued, fairly valued or overvalued compared to its current market price. Now if this is the last step over here, see you've already calculated, this is the final step. Now after this you will compare this share price with your current market price. This is what you're investing, and this investment would yield you certain results, maybe say after certain period of time, but that result you are calculating it at the present value of money. So on that present value of money, that is your discounted cash flow, you will find this the price of this share price is 8.33. So you will compare it with your current market price. If the implied share price is greater than your current market price, that means this stock is undervalued, meaning its trading uh, is lower than its intrinsic value. Now, this way investor may consider buying because the stock has upside potential. In case if this share price is less than the current market value, so this stock is overvalued. It means that the trading is higher than its intrinsic value. So investors may consider selling because it may be overpriced. So the implied share price in DCF it tells us what the stock should be worth based on future cash flows. Comparing it to the current market price helps investors decide whether this stock is a good investment or not. So this is all about discounted cash flow. I hope you've understood the topic. In case if you have any queries, you can write to us at www.bispsolutions.com.